all, welcome to Portfolio Manager. I'm your host Niraj Shah. On the show, we try and get into the minds of the portfolio manager to try and understand how is it that she or he is building out the portfolio or making the portfolio construct to generate alpha over the next 12 to 24 to 36 months. Our guest today is Tridib Pathak, who runs the Avendus Olivo core equity portfolio. It's in a scheme with a AUM of roughly 420 crores, and since inception has had a decent performance relative to the benchmark index, which is the S&P BSE 500 TRI. Tridib, thanks so much for taking the time out and being with us on the show. Can you tell us a bit about the scheme and about yourself? What kind of portfolio manager are you?
Well, Niraj, thank you very much for inviting me. So we are basically fundamental equity investors, more focused on businesses which are capital efficient and which have sustainable growth. And at the same time, we don't like to overpay for things. So, we are very cautious about what we pay for. So in a way, we are more fundamentally driven, long-term oriented. We like to invest in businesses rather than investing in stocks, I would say, we very strongly believe that stock market returns are generated ultimately and finally only through the underlying business growing, and it getting reflected over a period. In the meanwhile, there's always a lot of volatility and noise in the markets, which we tend to ignore,
So a particular index or a sector may find it difficult to have very substantially higher growth relative to maybe the economy, at least the economy linked sectors, Tridib. I'm just trying to understand, at the current juncture with the global growth looking a bit fragile and Indian markets not necessarily cheap, are you getting quote unquote the GARP valuation or growth at reasonable price valuations within this Indian landscape when you're trying to choose stocks for the next 12 to 24 to 36 months?
Certainly, yes, Niraj, and surprisingly so, we find a number of opportunities even today. I guess the fundamental reason is over the last few years and 10 years rather, the depth and the breadth of the Indian market has expanded quite dramatically, So even today, we do find a number of opportunities across various sectors where we find much higher growth possibilities. Some examples would be manufacturing. Nearly 40% of our portfolio is focused on manufacturing companies, which derive their competitive advantage from much improved infrastructure, lower labor costs and all that. Some examples out here would be EMS companies or textile companies or even auto banks, and we find them growing at a much faster pace. Other things other sectors where we find much higher growth is obviously private banks and insurance companies, life insurance to be specific.
Now, with every investment comes this argument that there is always a way to look at it, a glass half full or glass half empty. So I'm going to try and probe a little bit into your portfolio and the psyche that you have when you're trying to choose some of these, right? So banking, if I'm not wrong, banks and NBFCs together constitute about 22.9% of your portfolio. Now, this would make you, unless I'm very wrong, a bit relatively underweight to the index weightage that we have. Correct me if I'm wrong. And if so, is that because you believe that while there might be growth, supply side from maybe global institutions who are selling some of these banks and are overweight there, a reason why the true valuations may not get captured in the next 12, 24 months? Or why is it that it has the weightage that it has? And what within this landscape do you like more? Because while the top tier banks, sorry for the long question, but while the top tier banks have not performed as well, we've had idiosyncratic reasons as instances of mid-sized banks having done really well in the last 12 to 24 months.
So fair enough, 22.9% weightage is definitely a little lower than what is represented in the benchmark. But as such, our strategy involves in independent and individual stock selections, and we don't really get measure ourselves against a particular sector weightage and all that. Having said that, our individual positions do add up to a sector position, which is what you are able to see. We do within the financial services space also. We also like life insurance, as I said. I'll come to that later. But within the banking sector, our focus continues to remain on the larger private banks, including the mid-sized private banks. Okay, both of them, there are equally good opportunities available. And you mentioned about the fact that they have underperformed, which is all the more reason to believe that there is a far more higher opportunity. In fact, the private bank sector is one area where we find stock opportunities which are at a lower valuation than their past averages, ironically, whereas the market is at a higher valuation than what its average valuations have been in the past. So we do find a bargain out there. We are quite patient, and from a longer term point of view, the larger private banks as well as the mid-private banks will continue to gain market share as we go forward. They're growing quite well, and they'll be able to manage, we believe, their overall asset quality as well as net interest margins quite stably. So I would think, and just to mention about the fact that about the 23% from a bottom-up basis, we find very interesting opportunities in the life insurance space. Most of these companies, the share prices are telling you, if I were to do a reverse DCF, they're telling you that the premium growth in this industry is going to be only in the region of 2 to 3% or 4% max, which is not the case. So we do find a lot of opportunities which are attractive from a valuation perspective as well.
You could have made a similar argument around life insurance, Tridib, 12 months ago as well, maybe, wherein they looked attractive then, or they looked attractive even 24 months ago. But I was looking at either the private ones since 2017 when they circa 2017 when they listed, or the PSU ones. They haven't quite generated wealth. Now you could argue that because they've underperformed, they'll outperform, but that could extend itself for another 1 year as well. What is ailing these businesses or these stock prices, if you will?
So I guess there has been a correction in the valuations. I agree with you. Maybe partly, there were there was too much of expectations probably 2-3 years back. There has been some regulatory interventions of late about the surrender value thing. But if I were to just look at a little longer term in terms of the prospects for the sector, in terms of the fact that there is a lot more to go on penetration, and more importantly, I think the overall product mix slowly as you go forward will keep shifting towards the protection policies, which have much higher margins per se within the basket. So we find that the whole sector is moving towards more protection over a period, and certainly it will be able to take advantage of the under-penetration as well. And when the valuations tell you that the embedded growth in the share prices is hardly 2, 3, 4%, when the actual growth possibility could be anywhere in the region of 10 to 15%, then it basically shouts at you to say that, from a longer term perspective, there is definitely a good amount of ability to gain from this scenario.
Okay, fair point. Before we take that break, moving from something that has been a large portion of your portfolio, or is a large portion of your portfolio, and yes, viewers, 22.9 on banks and NBFCs and about 9% on life insurance. So that's collectively a fairly large or a reasonable allocation to both lending and non-lending financials. What I found absent, and again I may be wrong, but based on the sectoral breakup that I look, some of the high-flying sectors have been the likes of defense, railways, the last 12 odd months. They don't find a place in your portfolio, do they?
Yeah, they don't directly. There are a couple of businesses which do benefit from the railway capital expenditure. We have a business which is a part of the Vande Bharat, train system. But specifically what you're saying is right. We don't have direct exposures to defense or railways. we find valuations have stretched out quite a lot now. Okay. In fact, most of the entire PSU sector, I would think, there is a lot of higher valuations now than it were earlier. And we probably are not able to gauge, good opportunities, bottom-up opportunities which are at attractive valuations. I think that would be the fundamental reason. Let me admit, we may have missed a couple of these opportunities in the past, but we have been relooking our whole portfolio strategy, and we think we are okay with not having them in our portfolio at this stage.
Tridib, come in on this. I wanted to ask this to you. Does this worry you? There's so much chatter around how small caps have become completely avoidable, untouchable, what have you. And here I have a portfolio which has got a refreshing mix of large caps and mid caps as well, and small caps too.
A fair point, Niraj. It's an interesting question in the right context. But let me step back and explain our thought process. We are market cap agnostic in a way, in the sense that we do not believe, and we think investors also should not fall into what we call as the definition trap. A lot of people use the words large cap, mid cap, and small cap, and they invest according to the size of the market cap. We think what matters in investing, again, fundamentally, is the underlying business. It doesn't matter what is the size of the business or size of the market cap per se. But there is herd mentality which happens, and allocation happens towards market cap sizes and all that. We are aware of that. But our whole way of working has been that, look, we are going to look at the underlying business because, no two mid-cap companies are the same, right? If you compare two mid-cap companies or two small-cap companies, they're not the same. It is just that they belong to a certain size categorization, but their businesses could be completely different with very different horizon in terms of growth, in terms of prospects and all that, So we would rather focus on the prospects, and that is why, but from a liquidity management point of view, obviously it's important to have a balance. So we've always maintained our stance that we are a multi-cap offering, which in a way, because it is multi-cap, it is also market cap agnostic. And if I were to go into the historical, ranges, our large cap exposure has ranged in the, from 40 to 60%, and the mid and small cap also in the same way, 40 to 60%. But it is more focused towards the choice of the businesses rather than the choice of their size,
So when I look at the sectoral breakup, Tridib, and we discussed the two ends, but now I'm talking something in between. So I could argue that maybe textiles, maybe select pockets of real estate, etc., would certainly, or maybe auto ancillary would certainly be the mid-cap, small-cap flavor. What forms a part of the mid-cap, small-cap space? I know you're not investing by market cap, but if you're choosing to invest in a small-cap company in a particular sector, it'll be interesting to know.
Sure. No, certainly. So I referred to manufacturing, and I referred to quite a lot of opportunities within manufacturing, the EMS part, the textiles part, the auto anks part, there is another part which is housing finance. So that forms a part of our mid-cap strategy. Interestingly, our whole portfolio is focused on consumer discretionaries, and we find a lot of consumer discretionary ideas in the mid-cap and the small-cap space, as opposed to consumer staples, which are largely in the large-cap range. We feel that the consumer discretionary sectors would do far better, simply because there is a rise in per capita incomes. What was considered as a discretionary consumption, very soon and very fast, it is turning into non-discretionary, I would think, So we find a lot of opportunities. Some examples out there would be QSR, quick service restaurants, even real estate for that matter, and so on and so forth.
Interesting. Okay. Auto ancillaries has an auto and auto ancillary. I would love to talk a bit about that, considering that here's one pocket wherein I've heard completely chalk and cheese commentary post Q3. If Baba Kalyani's comments around what could happen to demand was one end, some of the others that we spoke to, a Sona Comstar, RK Forging, what have you, they're all citing that they are not seeing any issues thereof. I would love to understand What is your view on autos and auto ancillary in particular?
Right. So I think again, in autos, of course, we are focused more on the premium side. We find, there has been premiumization, and as I said, consumer discretionary part. We've seen low ticket items, not consumption at the low ticket item level has not been growing much, but at the premium end, there has been a good amount of growth. So within auto, our focus is more on the premium end. And coming to your question about auto anchs, I think it's more company and business specific. I would think it's quite a large sector, and a lot of auto anchs companies are export oriented as well. So it all depends on what chain they belong to, and what is the competition out there, and in terms of the product categories. So it would be difficult to really paint one brush. But we are focused on businesses within that, which are more futuristic in terms of technology, where they're able to, rather they've already taken strides in terms of competitive advantage through their technological edge, and are into sunrise applications and sectors. So I would think it is more business and company specific.
Okay, point well noted. You do have an exposure to information technology as well. Is this ER&D? Is it IT services? Is it large? Is it small? And why is it here when discretionary demand, in the words of the companies, isn't quite turning around the corner anytime soon?
Oh, interesting. So within that space, we have an exposure to the advertisement, the ad tech space, and also to a product company in the banking platform. So unlike, we don't have much exposure to IT services per se, by choice. It's more towards platform companies within the technology side, be it the advertisement technology platform or be it the banking products platform.
Okay, point well taken. Okay, so this is, this is more the platform companies which got de-rated for a bit and have just suddenly found resurgence, save for a fintech player which is under the eye of the storm. Most others seem to have done reasonably okay. So I think it falls under that bucket.
Not exactly. I would think in the sense that not in that loss-making so-called new generation companies per se, but highly profitable companies in the technology and platform space with a return on equity of more than 20%, and that is where our focus has been.
Okay, do you guys buy and hold for a really long period of time, or is it there's no such framework that you may take the gains when they come and it's not necessarily held for a long period? Just trying to understand your psyche.
Sure. So our investment horizon, the way we look at things and expectation wise and all that, investment horizon is anywhere from 3 to 5 years. Okay. But the holding period could be different. We may have to book profits in case our position really does well, and we need to size the position per se. So we do take action when we have to size it, but typically our horizon is definitely 3 to 4 years, not less than that. A holding period could vary depending on what is happening with the stock or with our position within the portfolio and the size and all that.
Got it. My final question, Tridib, you told us about a few pockets like defense, railways, etc. In some of them where you now don't find the risk reward to be favorable. Where is it, aside of that you are negative on, wherein you believe that either the valuations or the growth prospects are firmly stacked up against the fortunes of the sector or the companies?
Yeah, so if you look at the vast majority of the kind of businesses which we don't have in our portfolio, they would belong to the IT services space. I'm talking the services space, IT services space. They would belong to, I would think, the overall the global commodity space, which you normally like to avoid, okay, because we don't have much knowledge or ability sitting here in India to take a gauge on how the commodity prices are going to move. So I would think metals, commodities, IT services, businesses out there we don't have any exposure, I would think, in our portfolios at this stage, because of the reasons which you pointed out.
Got it. Okay, great. Tridib, lovely trying to understand how you think about some of the markets and the investments and your portfolio breakup as well. Thanks for taking the time out and speaking to us today and giving us your thoughts.
Thank you, Niraj. Thank you for inviting me. And it's been a pleasure talking with you. Thank you.
Likewise. And viewers, thanks for tuning into this edition of The Portfolio Manager.